Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Brian Madden is on the show today. He's Chief Investment Officer at First Avenue Investment Counsel, and he will be taking your questions on North American Equities. Here's how you can reach us. You can call us toll-free, 1-855-326-6266, or you can send us an email at marketcall@bnnbloomberg.ca. Brian, of course, joining us in studio today. It's great to have you.
Thanks for having me.
What an interesting couple of weeks it's been. I know you say that, you've been kind of acting business as usual when it comes to how you're trading right now, but I wonder if you can take us through what that means and also just your thoughts on what we're seeing today in terms of the market kind of just flipping around.
Yeah, of course. So, I mean, to the whole, zooming out to 10,000 feet, let's say, portfolio construction, we're sort of a planning-led firm, so we write strategic investment policy statements for clients that might include exposure to equities in our dividend growers or our momentum mandate, which are invested in North America, but we'd also have cash, fixed income, real estate, private equity, and an alternative income strategy. So clients have very well-balanced portfolios, and as such, they're built to be resilient for, let's say, all-weather conditions, including wars. And so it affords us, the team that I lead, managing the equity portfolios, the luxury or the room not to react in knee-jerk fashion to geopolitical risk or headlines. And so as such, more or less all year long, we've been, by and large, fully invested in the equity portfolios. And the business as usual part that you alluded to really entails routine sort of culling or pulling of weeds from the garden, so to speak, selling things that haven't worked or where the thesis has been negated, picking the roses as well. That's to say, partially trimming winners where, we've been validated or proven right and the stock has gone up and become an outsized weight in the portfolio. And then, of course, selectively introducing new ideas, including some dip buying, notably in the gold sector in the middle of March, and just sort of various other bits and pieces of normal course activity. We get that the world's got its hair on fire, and quite understandably so. War is, very serious, takes a huge human toll. But our view and our practice is not to let it rattle us unduly when it comes to investing, because when you invest, you should always do it in a place of calm, cool, collected ice in the veins, so to speak.
And you say that you've been doing that. You haven't been doing any kind of having knee-jerk reactions to anything. It can be hard, though, for a lot of investors to not see the price of something going down and wanting to react to that. So is there anywhere that you made some quick movements ever since this war broke out, or really across the board it was staying calm and steady and not reacting to what's happening too quickly?
Well, I would say the sort of nimbleness, the characteristic nimbleness that our team practices and navigates would be best evidenced by buying, well, actually twice. So trimming golds, which had been a long standing core and significant position in both of our equity mandates, really dating back to 2022 when Russia invaded Ukraine. And by the way, that war is not over either. So that sort of whet our curiosity and sort of sparked the idea that fiat currencies might become a bit of a no-fly zone for certain central banks. And of course, we've seen central banks buying gold hand over fist for 4 years and counting. So we did sort of see a bit of froth emerging in that long-standing bull run in the gold sector and took partial profits in January. But then, the bottom fell out of the gold trade when this other war broke out in Iran, and more so than we thought was warranted. And we thought it was sort of reflexive and perhaps indicative of margin calling and weak-handed players getting shaken out. So we added back to some of the names in mid-March, and we've seen them bounce nicely. And so gold continues to be an anchor position in both our mandates. Elsewhere, and I don't really want to let the cat too much out of the bag, but one of the top picks is a recent addition to our dividend growers mandate that we added during the month of March on weakness. So, that to us is the definition of active management. Eye on the ball and looking for opportunities every single day, every hour sometimes.
Got it. Okay, so we're going to take a quick break right now. We'll be back, though, with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities right after this. Stay with us. Welcome back to Market Call. Brian Madden is on the show today answering your questions. We're going to start with an email question from our inbox. Brian, would you enter, and this one reads, would you enter Bird Construction at today's price, or do you have a better recommendation?
Yeah, interesting question. We do have a better idea, and I won't divulge it because it's going to be a top pick later, and it's not exactly a perfect substitute for Bird Construction, but teaser here is that it's an engineering and construction engineering services company. This company, we do kind of like, we don't own it. Wouldn't really have any qualms about buying it. It's not a household name, so for those who don't know, I'll just say it's a general contractor that builds industrial buildings and infrastructure, and so they're involved in energy, defense, trade and transport, healthcare, nuclear, and actually they've got some pretty high-profile projects in their backlog or underway. Notably here close to home, the Peel Memorial Hospital in the west end of the city is one of theirs. The BHP Jansen potash mine, which is set to begin operations next year or the following, and they're part of both phases. So this could potentially be the biggest potash mine in the world, 8 million tons a year. So that's something they're working on. They're involved in the Bruce and the Pickering nuclear reactor life extensions and various other things, wood fiber, LNG terminal on the West Coast. So this has been a really good grower and compounder. It does pay a dividend. The history of it is it used to be an income trust, and I think that may be why. I can't confirm 100%, but I think when it converted from an income trust to a corp, it cut the dividend in half, and that was about 2016. But since that time, it has grown the dividend at a 10% compound pace over the last 8, I guess, years since then. It yields about 2% now. It trades at 15 times earnings. The shares are trading at all-time highs. It's got a really strong chart, making higher highs and higher lows. And, it's had a 10-year total shareholder compounded rate of return of 20%, which is extremely competitive in the absolute and relative to the TSX, which has done about 12 point something % over that time frame. It's all underpinned by this sort of big addressable market in the verticals they service, and their backlog between firm and pending contracts is about 5.1 billion firm, and another 6 that they say is pending or in the pipeline. So just on the firm committed basis, that's about 1.5 times their trailing revenues, and on the firm plus pending, it's more than 3, close to 4. So it all looks pretty good here, so no qualms about buying it, although we don't own it ourselves. It is a bit small, I will say that. It's a $2.3 billion market cap. The name that we prefer that's sort of a bit adjacent is much bigger.
And we'll talk about that later. Good
You bet.
tease. Okay, we'll go to the phone lines now. John is calling in from Milford, Ontario with a question for Brian. Hi, John. What's your question?
Hello, Lindsay and Brian. I'd like your thought on National Bank going forward. I've owned it for a lot of years. I bought it at $39, and I own all the banks, and what a beautiful day for banks. Give me your thought going forward. Thank you very much. Bye.
Okay, thanks for that.
Thanks, John. Yeah, there's a lot of green on the screen today, sort of shooting fish in a barrel, so to speak, including for the banks. This is not one that we own. We own 3 of the other ones. This one catches our eye from time to time, and, we like it all the more so post this acquisition of Canadian Western Bank. There was a time when this one sort of got lumped in with the smaller players. We didn't talk about a big 6 group of banks. We talked about the big 5, and then you had the also-rans like your Laurentian and your National, Canadian Western Bank, and EQ Bank, which of course is now gotten bigger with the acquisition of PC Financial. But National Bank is legit at the big boys and girls table. It's one of the big 6 banks, and it's a veritable national presence post the CWB deal, which should be synergistic both in the costs and the revenue side. Good wealth management business to round out the deposit and lending business, good and getting better capital markets business. And of course, the CWB business has got an excellent commercial banking franchise. So I think all the banks are buy and hold compounders. They run in a tight oligopoly that's well regulated. They have strong governance and good internal succession planning. And so I think the general algorithm for total shareholder return compounding for these banks is you take the dividend Most of the time it's between 3 and 5%, depending on which way the wind's blowing, which bank you're talking about. And then most of them aspirationally try to grow the dividend at a high single-digit pace year in and year out through the cycle, and generally succeed. So you stack those two together, and you got a pretty good line of sight to a low double-digit compounded rate of return over a cycle. So that's been the case historically, and we think it will continue to be going forward. So if I were you, I'd remain long and strong on the National Bank here.
For sure. Okay, we're going to go back to the phone lines. Terry is calling in from Edmonton with a question. Hi, Terry.
Good day. Yeah, they say that copper is the new oil. So there's a shortage of copper, and the demand for it is going to go up like crazy. So do you have a copper name you can give me in Canada? Thank you very much.
Thank you. We've circled copper with some interest. People call it the metal with the PhD in economics. Our preference in terms of resources has been oil, gas, and gold. But yeah, we think maybe some of the cyclicality might be coming out of copper. I don't necessarily agree with the assertion that it's scarce. It's not a precious metal. It's not a rare earth. There is lots of it. But I think I do take your point. We take your point that it takes a long time to bring a new mine, get the permits, and get it into production, especially big world-class mines. Notably, one of the biggest in the world has been shut in for probably going on almost 3 years now. That's the Cobre Panama mine, which First Quantum owns in Panama, which when the government changed and went kind of leftist in Panama a few years ago, the environmentalists sort of hijacked the program, and the mine has not produced for a number of years. We think that may change, which makes First Quantum interesting. I can't go quite so far as to say that would be our horse in the copper space, but I think it is worthwhile considering copper to be a bit less cyclical. I mean, it used to swing wildly from $1, at which price nobody's making any money, to $3 or $4, and now probably the floor price for the metal is higher and the ceiling price is higher because, as you know, it's in everything from electric vehicles to data centers to grid modernization and ruggedizing. And so probably it's going to see a period of time where demand outstrips supply, which should keep prices well bid and should allow the miners to make pretty good money. There's only a few of them to choose from that are pure plays or close to it on the TSX. So some that you could consider looking at would be Lundin, First Quantum, Hudbay. But as I say, we don't have a strong recommendation amongst those three, but we are looking with heightened interest lately.
Okay, we're going to take a quick break right now. We will be back, though, with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities right after this. Here's how you can reach us. Hi there, welcome back to Market Call. Brian Madden on the show today answering your questions. We're going to go straight to the phone lines because Chris is calling in from Delta, BC with a question. Hi, Chris.
Oh, good morning, Lindsay and Brian. Thank you, as always, for taking my call. Brian, I'd like to ask you on Lennar and the home builders in general. I've heard some portfolio managers that I hold in high regard recommend these names for a long-term investor, which is what I consider myself 5+ year time horizon, potentially 10 years. And I'm wondering if you see the thesis of chronic underbuilding and undersupply of homes in the United States as being investable for the long term. And if you do, which names would be most appealing to you? I'll hang up and listen. Thank you both.
Great. Thanks for the call. Lennar is not a company we own. But I would strenuously disagree with the underlying premise that these are buy and hold investments due to structural underbuilding in the United States. Housing is extremely cyclical. We know that. We're sort of feeling it and wearing it to one degree or another in all the major cities in Canada. The U.S. is maybe facing some different dynamics, but these are at best a trade, so there might be an occasion for a trade, but a buy and hold over 5 years would definitely not support that thesis. There's only a few to pick from that are publicly traded in the U.S. Lennar is a good one, but I think you want to think of these as sort of tactical trade opportunities, and you want to think about it with a macro lens. Is the economy accelerating? Is employment accelerating? Are interest rates going down? We don't really have a clear picture on all of those things enough to give us strong conviction to get on it in a sizable way, even for a trade at this juncture. If the war settles, then you might have more clarity to the Fed cutting rates, but knock on wood, there's a ceasefire, but it's not, really a full conclusion to the war. Employment is not improving. And then finally, the other underlying very important demographic factor is the U.S. is not really a very welcoming destination for migrants as it was even a year and a half ago with changed immigration policy. So that is a structural headwind to housing demand. So would not sort of support the underlying thesis in this case.
Okay. Good to know. We're going to go back to the phone lines. Ray is calling in from Pickering, Ontario with a question. Hi, Ray.
Yeah, hi. Good day, Lindsay. Brian, I've been a long-term holder of Berkshire Hathaway, and I've just been hearing that the insurance side of the business has been getting beat up, and I just would like you to explain why insurance is being beat up with this stock, and since it's kind of been flatlining lately, do you think it would be a good time to add to my position?
Yeah, thanks for the question, Ray. So we don't own Berkshire Hathaway. It is a bit of a strange beast. We're active managers, which means we sort of go out and hunt a rifle shot for individual securities. This is sort of a conglomerate, or really, in effect, a diversified portfolio masquerading as a single stock, as I'm sure you know. But yes, you're right to point out one of the long-standing kind of anchors or pillars of the organization is insurance, Geico in particular. So that's property and casualty insurance company. We own some property and casualty insurance. We have sort of taken a rifle shot as we do there and picked what we think is a best-of-breed Canadian player, but would acknowledge there are some cyclical headwinds potentially sort of brewing for the P&C insurance sector. They have been probably, I think we'd concede, over-earning for a few years, having very low combined ratios, and thus earning pretty high profit margins, and also at the same time earning outsized returns on their, generally speaking, very large bond portfolios. There's now some more capacity being attracted into the space, courtesy of the strong profitability the sector's enjoyed in recent years. It's competing on premiums, so you're not getting sort of that inflation in policy premiums that you were to the same degree as in recent years, which may pressure margins. And at the same time, the likely path for interest rates is probably more so down than up, which will pressure the investment income on the big bond portfolios. Having said that, there's lots of other reasons to own Berkshire Hathaway. Notably, it's got a great portfolio of iconic trophy, buy and hold forever, as Warren Buffett, I think, would probably say, businesses. So on that basis, we could probably support buying the dip in the shares here, but it wouldn't necessarily be predicated on the insurance business per se.
Okay, thanks for that question. Back to the phone lines. Bob is calling in from Bowmanville with a question for Brian. Hi, Bob. Okay, we might have lost Bob, but we know that Bob was going to ask about gold in general, and I know you were saying you have been buying a little bit more gold, buying on the dip. So thoughts on gold at this time?
We like gold. We've liked gold for 4+ years and have sort of built up a pretty good weight, a double-digit weight in both of our two equity mandates. One's momentum-centric, the other is looking for dividends. So you own a diversified basket of gold exposures between the miners and the royalty companies. But the underlying thesis is that gold is in a strong and multi-year secular uptrend, and that's because it's really the only proven non-fiat currency. Yes, I know I probably sound like a dinosaur. The younger gen would say Bitcoin is digital gold. Well, yeah, not so much in the last 4 or 5 months.
Gold is gold.
Gold is doing what it's done for millennia. It's serving as a store of value, as an inflation hedge, as a geopolitical risk hedge. And A lot of it is underpinned by the central banks that have been buying it hand over fist in a move to diversify away from treasuries. So much so, the gold is now the largest combined reserve asset, outweighing U.S. treasuries on the balance sheets of the world's central banks. And of course, we know why. It's because financial reserves can be sort of frozen at the stroke of a pen, as Russia found out the hard way when they invaded Ukraine, and other, let's call them despotic countries that maybe are at risk of finding themselves in the not so good graces of the United States, which runs the SWIFT interbank large value transfer payment system, decided, maybe we don't want a lot or all of our reserves in treasuries, and they're buying gold, and you see it in the chart. So we like gold and are overweighted in both our equity mandates in a variety of different ways, and have been buying on dips in the last month.
Got it. Okay, we're going to take another quick break right now. When we return, though, we'll take a look at some of Brian's past picks. That's next. Stay with us. Welcome back. We're going to go through some of Brian's past picks now. These are from March 21st, 2025. The first one, Brian Couche-Tard, recommended at $70.37, now at $81.45. Total return of 17%. You still holding this one?
Yes, we are. We've owned this for quite some time. It's a company that operates a global footprint of convenience stores, from humble roots in Quebec and then moving into Ontario, the United States, and into Europe and Scandinavia, Hong Kong, and potentially other regions are in scope for acquisitions, of which they've got lots of financial firepower to do. Mm-hmm. But more interestingly and more importantly, they have rebooted the management team. There's a new CEO, Alex Miller, took over from Brian McNanash about a year and a bit ago. They walked away from 7-Eleven since we first picked this a year ago. The market was not all that warm and fuzzy on that deal, so I think that sort of took a bit of the pressure off. But they've really tried to sharpen their merchandising sophistication, rolling out digital loyalty programs, getting good traction. They're doing a lot better job with in-store food service, which carries higher margins than most of their in-store merch. And are earning above industry average fuel margins, albeit amidst sort of tepid demand in most of their regions. And the shares, we think, are trading at an undemanding valuation, and they should have easy earnings comparisons setting up for them after an unprecedented 2 back-to-back down years for earnings per share, which they've never ever had in 30 plus years as a public company. Wow. We think there's more upside here, and it could get interesting if they deploy some of their ample financial firepower to put a flag down some other region where they're not currently operating, because they are good acquirers and good operators.
Okay, your next one is a utility service company, Vistra, recommended, or is it Vistra?
I call it Vistra,
Vistra.
but
right.
You say potato, I say potato.
Recommended at $130.58, now at $158. Total return of 22%. Did you keep this? Did you trim? What did you do here?
So we did keep this. We continue to own it in our momentum mandate. You can see from the chart there that it rallied sharply early last year and into the summer. And it's, this in prior years would have been kind of a dull and low beta and unexciting utility stock. And that's actually what it is. It's an electric power utility operating a big footprint in Texas and in the PJM, which is the Mid-Atlantic region, Pennsylvania, New Jersey, Maryland. Mm-hmm. They operate a reasonably sized fleet of nuclear power reactors. They're striking some deals with the hyperscalers to get sort of always-on clean energy with those nuclear assets. And so it's been, a lot of ink has been spilled about this. Electric power prices have been very inflationary because the huge build out in data centers and AI compute demand is consuming all the power the grid can produce and then some. So we think that is going to go on for some time. And in fact, we added it to the portfolio as sort of a second derivative on the AI trade, having already had lots of exposure to it in both our equity mandates, but wanting to get a diversified basket of AI and AI adjacent exposure. So we think there's a good secular growth runway in front of it here still.
Interesting. Okay, last one is KKR, an investment company. So recommended $116.50. Now it's at $95.14. So total return down by 18%. You still holding this one? What happened here?
We are. This one has drawn down. We think probably this is one of these baby thrown out with the bathwater cases of undue concern about their exposure to private credit, which is another topic that's been getting a lot of airtime. Originally, remember, this is the granddaddy of all private equity stories. They were involved in the RJR Nabisco buyout, of which the book Barbarians at the Gate was written about in the late 80s. And so, they basically invented private equity. So that's sort of their roots, but they also have private credit strategies and real estate and various other things. But it's sold off, and we think probably by an undue amount. So we think there's a good secular growth opportunity in front of them as more and more dollars move out of conventional public markets and into private market alternatives. And, it's something we know very well, embracing, a full sort of slate of products and solutions, including proprietary private market alternatives ourselves. So we continue to own these shares and have a lot of conviction in the management team and their global franchise in these asset classes.
Just kind of waiting out, hoping things take a turn. Okay, we're going to take a quick break right now. We're going to be back, though, with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities right after this. Welcome back to Market Call. Brian Madden's here answering your questions. We're going to go straight to the phone lines. David is calling in from Etobicoke with a question. Hi, David.
Hi. Hello.
Hi. What's your question?
Can I ask Brian what is his opinion on the IFC, Intax Financial Corporation?
Okay. Thanks, David.
Thank you, David. This is a company we own in our dividend growers mandate. Have owned it for 4+ years, longer. I don't recall exactly how long, but this is the biggest property and casualty insurer in Canada, serving home and auto and commercial insurance policies up. It's also a big player in specialty insurance in the United States and in the UK and Ireland post the acquisition of the RSA, Royal and Sun Alliance business that they did about 3 or 4 years ago. The shares have pulled back and corrected. We like the valuation. We like the growth prospects going forward. Their aspiration, which they've perennially managed to meet, if not exceed, is to grow their operating earnings per share by about 10%. So with the shares trading at 15 or 16 times earnings and prospectively earnings growing about 10%, we see a pretty good combination of value and growth here. Plus, there's the ongoing consolidation and roll-up story. They continue to deploy capital in sort of little bits and pieces, dribs and drabs, buying up in what we'd call a vertical merger and acquisition strategy, buying insurance brokerages and agencies, a very fragmented space. And then the bigger, chunkier deals are the insurance companies, the underwriters themselves. And there's still lots of market share to sort of gobble up there because it's a fragmented market and there's lots of owners, foreign subsidiaries of European or overseas insurers that we think are probably poised to be sellers and other sort of not-for-profit or mutually owned insurance companies that could be up for grabs. And Intact is the logical acquirer and the one with the strongest balance sheet and the best operating history to be positioned to do that. So good time to be buying on the dip here, we think.
Okay. Back to the phone lines. Another caller from Etobicoke. This time it's Glenn. Hi, Glenn. What's your question?
Hello. Thank you for taking my call today. I would like to know about CGI. It has high institutional ownership, and in the software sector, it's being hit down, and now it's trading sideways. Do you think this would be a good stock to add to a portfolio based on evaluation?
Mm-hmm. Okay. Thanks, Glenn.
Thank you. No, this is not a company that we would be adding to portfolios. We don't own it. I can't recall us owning it at any time in the last 4 years. It's a systems integration and business process outsourcing company. It's very, human capital heavy. I think they have 95,000 employees. So it's not the largest TSX tech company by any stretch of the imagination. That distinction goes to Shopify, but it's probably the largest IT employer in the country. And I should say that all of these sorts of companies, a big US comparable to CGI would be Accenture. They've all been under pressure. And the sort of proximate explanation is the threat of AI and what they call vibe coding in particular. So do you need all these highly paid and specialized IT experts if companies can insource it? So we don't necessarily fully subscribe to that agreement, but there's probably some merit to it, and it is perhaps a bit of a threat to the company. And then beyond that, we just don't see a lot of very strong or dynamic organic growth here. They're mostly serving mature end markets in government and financial services and retail, manufacturing, distribution. So we just think there's more exciting companies that you can own in the tech space. And finally, just to address the point about big institutional ownership, this is a Quebec darling, and I think the big institutional ownership, probably the biggest chunk of it is the Caisse de dépôt, which is a mandate to support Quebec-based companies. So they're sort of always there in support of the company. That's not the only institutional owner, but that's a big one and a big part of that chunky institutional ownership. But we'd give this one a miss for now.
Okay. Back to the phone lines. Gail is calling in from Monotic, Ontario with a question. Hi, Gail.
Hi. Good afternoon, Lindsay and Brian. Brian, you're one of my favorite guests, and I do own some Allied property. And today in the Globe and Mail, there's a great article about office real estate. I would really like your opinion on Allied, and I do thank you for taking my call. Thank you.
Thank you very much for the question, Gail, and for the kind words. And on a personal note, I think you're the first caller I've ever fielded from Manotick, Ontario. But that's my hometown. I grew up there and went to high school there, so small world. To the question at hand, Allied Properties, we used to own this. I concede I might have a bit of egg on my face as a result of this one. We believe this was sort of a contrarian turnaround play, the thesis being a return to office mandate and a recovery in their occupancy rates, which, given the operating leverage inherent in a landlord or real estate company business model, would have flowed through nicely to their funds flow from operations and supported what at the time was a pretty juicy dividend yield of 7, 8, 9%. We were wrong, and they cut the dividend sharply by 60%, I believe, in December. And then adding insult to injury, they did a very dilutive secondary offering of shares in late January, early February. We've lost confidence in the strategy and the leadership. The chairman stepped down, Michael Emery. And so we sold the shares about a month ago, fairly close to these levels. And so we just lost confidence and conceded defeat and moved on and put the money in other areas where we see better opportunity and have more confidence and conviction in the management team and the strategy going forward.
Okay. We'll leave it there. We're going to take a quick break once again, but we'll be back with Brian Madden of First Avenue Investment Counsel. He's taking your questions, of course, on North American Equities. Here's how you can reach us. Welcome back. We're going to go straight to the phone lines. Got lots of questions lined up for Brian. Stefan is calling in from Montreal with a question. Hi there. What's your question?
Hello, Brian. You mentioned that you were in commodities and you were specifically in gas and oil, and I can't remember the other one. But there was a pullback in oil today. I was wondering if you would take a part position with the pullback today, considering that this whole thing in Iran might not be over yet, and I would be expecting a greater pullback in the future. So, and if you have a Canadian oil patch name to suggest. Thank you. I'll wait.
Great. Thanks for the question, Stefan. So, yeah, you're right to acknowledge today is sort of a fast-moving day, and there's a lot of moving pieces. A lot of this pullback in oil hinges on what we affectionately can now call Taco Tuesday, or the so-called truce or ceasefire in the Middle East. We'll see if it holds. I might, apart from any investment advice or suggestions, counsel filling up your gas tank while getting's good because we just don't know how lasting this truce is going to be. As to the oil patch, I'll throw one name out now and I'll save one for later because I have one that's an oil services company that we'll talk about in the top picks section. But in the Canadian oil patch, if you want a exploration and production company, Tourmaline Oil is one that we've liked for some time and own. Now, it is not really an oil producer per se, despite the name. It is primarily a natural gas producer. It's in fact Canada's largest natural gas producer, but we're getting structurally more constructive on the prospects for natural gas, given that there is in continent and in region, in all likelihood, as Alberta is starting to build some data centers, demand for power, cleanish power, which natural gas is. And moreover, we have one operational, an LNG terminal on the west coast of Canada, and there are others under construction that should put a bid to Canadian natural gas, which is probably the cheapest and cleanest, certainly the cleanest in the world. Maybe Qatar has got the cheapest, but they're going to be cleaning up the mess and the damage to their facilities for at least 3 to 5 years from what we're hearing. So Tourmaline would be the horse there, and I'll save one for later that's an energy services company.
Okay, thanks for that. We're going to go back to the phone lines. We've got Harry calling in from St. John, New Brunswick with a question. Hi, Harry.
Yeah, hi there. My question is whether your guest feels that the whole telecommunications industry is in a broad secular decline or organic decline. It doesn't matter whether you have TELUS, Rogers, or Bell. If you look at the 3-year charts, they're all steadily dropping down. So would he see it as a space to not invest in? And I have TELUS. I'm down about 25%. The only thing it's got going for it is a high dividend. That's the question. Thank you very much.
Yeah, thank you for the question, Harry. We don't own any of the telcos. We don't necessarily agree in the draconian assessment that they're in secular decline, because they're not. They serve a need, not a want, and there's nothing that's going to make them technologically obsolete that we can see anytime soon. However, that said, you've got two drivers of revenue. One is price and the other is volume. So you have headwinds on both of those. So the volume headwind is we all need one, maybe arguably two cell phones. I don't know too many people that carry 3 around personally. So in some sense, the volume demand is a per capita sort of equation. And so Canada is restricting immigration policy more so than it did under the predecessor government. So that is a headwind to volume. And the headwind to price is a self-inflicted own goal in soccer parlance. These telcos are responding to the fact that the volume demand is not what it once was by trying to compete for market share. That's not just a zero-sum game, it's a negative-sum game, not quite mutually assured destruction, but no one's really winning because there's a price war, and you're seeing it in the share price. Finally, on TELUS, we know the cautionary tale here is BCE cut their dividend a lot about a year ago. TELUS, that dividend is at risk of, at best, growing slowly or not at all in the coming years, and potentially, if things don't improve, it could be at risk of following in the footsteps of BC. That should always be sort of a yellow cautionary flag. When you see a dividend yield that looks like it's too good to be true, your spidey senses should tingle because it might just be too good to be true.
Okay, we'll leave it there. We're going to take another quick break. When we return, though, we'll take a look at some of Brian's new top picks right after this. Join us tomorrow on Market Call. Lyle Stein will be on the show. He's president of Forvis Global Wealth Management, and we'll be taking your questions on North American and global stocks. And Know Your Options is back as well. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. You can send us your questions at knowyouroptions@bnnbloomberg.ca. Brian Madden joining us in the studio today. Time now for Brian's top picks. So first one, Brian, Trican Well Service. Tell us more about this company. What do you like about it?
So this one, as promised, someone else is asking about ideas in the Canadian oil patch. So this would be one. It's not a household name, but it is Canada's largest pressure pumper, fracking, and well services company. It's got a leading market share in the prolific Montney and Duvernay basins. It's been under management since 2020, and they have modernized their equipment, so they've got the highest spec fleet of frac spreads, and that's allowing them, through that and better utilization of equipment and personnel, they're able to flex some pricing power on complex jobs. Now, don't get me wrong, this is not a company with sort of purely speaking pricing power. This is very much a capacity, commodity-driven business where the margins can ebb and flow with demand and supply-demand balance in particular. What got us interested in it was last summer they made the very strategic and accretive acquisition of a private company called Iron Horse Energy Services, which we thought had a complementary business. They knew the management team well. There's $15 or $20 million of synergies for them to get after and realize in that transaction, which is consequential for a company of this size. It's about a $1.5 billion company. But we think at least cyclically and possibly structurally, there is a more constructive environment for well services, well completions in Western Canada with the LNG export terminals operative and with, in all likelihood, what seems to be a more resource and development and pipeline-friendly government in office federally. The valuation is undemanding. It trades at 10 or 11 times earnings, about 5.5 times enterprise value to EBITDA. The yield is about 3%. They reinstated the dividend 2 years ago. They've increased it twice, and they bought back half of their shares in the last 8 years. And it's on a dip today, so today's the day.
Buy on the dip. Okay, next one is Booking Holdings.
So this is the new addition to our dividend growers portfolio in the month of March. It is the global best-in-class online travel agency. So that stock chart looks like a double black diamond ski slope, and I should explain that the stock split 25 for 1, effective about 3 days ago. So it's really not as scary as it seems.
It does look pretty intense there.
Yeah, it does. So it used to trade at $6,000 a share, but it split 25 for 1. So now it trades at 180-ish. But essentially, they operate a three-sided ecosystem connecting travelers and travel companies, and then their own sort of online booking portal and sophisticated AI and payments engine. And they operate through banners that most viewers would probably be familiar with. So Booking, Agoda, Priceline, OpenTable would be just some of them. Addressable market they serve spans hotel rooms, flights, car rentals, restaurant bookings, and even increasingly private accommodations. And their edge that allows them to earn very high operating margins, north of 40%, returns on invested capital, 50% plus, is a very collaborative partnership with some of the traffic drivers like Meta and Google and increasingly the large language models. Very sophisticated AI tools themselves to reduce operating expenditures and enrich client experience. They've had an ongoing strong share buyback program. They've initiated a dividend in the last couple of years and boosted it twice. And the steep sell-off, we think, is a case of baby thrown out with the bathwater. The thesis here, which we think is totally erroneous, is that AI is going to disrupt this company and erode its competitive moat. We don't think that's the case. There have been many competitive threats and incursions in their 25-plus year history, and nevertheless, the shares have compounded at 29% since the turn of the century. So a great dip to buy.
Okay, last one. I believe you teased this one too throughout the show. WSP Global. Tell us about this one.
So this is a global engineering and construction company. They serve clients in the transportation and infrastructure and markets, also earth and environment, property and building and power and energy end markets, including data centers. Another case of AI baby thrown out with the bathwater. So the belief here is that specialty engineering talent is not going to be needed because AI is going to do it. Yeah, we'll see about that. Fat chance AI is going to build a nuclear reactor or a dam or a data center or what have you. Good book to build. There's $17 billion of backlog. That's about 1.2 times trailing revenues. We think they're addressing large end markets. And we think this company has got big global scale. They've made a large acquisition that makes them a much bigger player in power and energy markets in the United States recently. And it is a serial consolidator of this fragmented engineering space. So a good dip to be buying here as well, we think.
For sure. Okay, that's all the time we have. Brian, appreciate you coming in as always. Thanks so much.
My pleasure. Great to be here.
Yeah, and thank you for watching Market Call. We will see you next time. Trading Day is next with Roger Peterson.